Welcome to Taranov's Geopolitics. Tonight, we are looking at a financial battle so massive that it could reshape how countries think about money, sanctions, and even the safety of sovereign reserves. Russia has just won a court ruling worth more than $200 billion against Euroclear, one of the most important financial institutions in the world. And now, the question being whispered across financial capitals is simple. Could this legal war spread into Hong Kong, Singapore, or other global financial hubs? This is not just another sanctions story. This is about whether countries can truly trust the global financial system anymore. Because once sovereign reserves become part of geopolitical warfare, the consequences can spread very, very fast. One of the most significant financial and legal developments to emerge from the confrontation between Russia and the West is the decision by the Moscow Arbitration Court to uphold the Central Bank of Russia's claim against Euroclear. The court ordered Euroclear to pay approximately 18.17 trillion rubles in damages. In United States dollar terms, that equals roughly $200 to $205 billion. Russia argued that after February 2022, Euroclear froze Russian sovereign reserves following European sanctions. According to Moscow, this prevented the Russian central bank from accessing and managing its own reserves. The claim included both direct financial losses and alleged lost profits. Reports indicate that the damages include roughly $181 to $182 billion in actual losses, along with another $18 to $19 billion in claimed lost income. The proceedings reportedly lasted just over 5 months and were conducted behind closed doors. In the end, the Russian court fully backed the Russian position. Now here's where the story becomes much bigger than one lawsuit. Around 180 billion euros in Russian sovereign assets remain immobilized inside European financial systems. Much of that is connected to Euroclear's infrastructure in Belgium. European leaders have debated multiple options regarding those frozen assets. Some proposals involve using profits generated by the assets for Ukraine-related support. Others go even further and discuss outright confiscation. But legally, politically, and financially, that remains extremely controversial. And this is where Taranov's analysis becomes important. The Moscow judgment is not only about recovering money, it is also about sending a global message. Russia appears to be signaling that Western financial infrastructure itself may now face retaliation. Euroclear is not an ordinary bank. It is one of the most important securities settlement and custody institutions on the planet. Governments, central banks, giant investment funds, and multinational financial institutions all rely on systems like Euroclear to safely hold and transfer assets. So when a Russian court issues a $200 billion judgment against a financial institution of this scale, global markets pay attention. Even countries not directly involved in the Russia-West confrontation are watching carefully. For decades, many governments believed sovereign reserves held in Western institutions were effectively untouchable. Then came the freezing of Russian reserves in 2022. That alone shook assumptions across the financial world. But now there is a second layer of uncertainty. What happens if the custodians themselves become targets of massive legal retaliation? Suddenly, the entire conversation changes. Some countries may now reconsider where they store their reserves. Instead of relying heavily on European financial systems, they may move more money into gold, domestic reserve structures, regional alternatives, or non-Western financial centers. And honestly, this is where things start getting uncomfortable for the existing global order. Because once trust begins to weaken, rebuilding it is not easy. Euroclear has already stated that it strongly disagrees with the ruling and plans to appeal. The company also criticized the closed-door nature of the proceedings, arguing that the process violated principles of transparency, fair hearing, and due process. That argument could become extremely important later, especially if Russia attempts to enforce the judgment outside its borders. Euroclear's likely defense is relatively straightforward. The company will argue that it did not independently confiscate Russian assets. Instead, it simply complied with legally binding sanctions imposed by the European Union and Belgian authorities. Russia, however, sees things very differently. From Moscow's perspective, the result was the immobilization of sovereign funds and the loss of access to state reserves. Therefore, Russia argues that compensation is justified. So now we have two competing legal narratives colliding head-on. One side frames sanctions compliance as lawful mandatory behavior. The other side describes the freezing of reserves as an unlawful deprivation of sovereign property rights. And now we arrive at the question everybody is asking: can Russia actually pursue Euroclear assets abroad? In theory, yes. Russia can attempt to seek enforcement in jurisdictions where Euroclear has assets, operational exposure, accounts, subsidiaries, or commercial interests. But theory and reality are two very different things. Before foreign courts recognize outside judgments, they usually examine several key issues. Did the original court have proper jurisdiction? Was the process fair? Was the defendant properly represented? Would recognition violate local public policy? That means Russia cannot simply waive the Moscow ruling and automatically seize assets worldwide. Every jurisdiction would become its own legal battlefield. Hong Kong immediately stands out as one possible arena. The city remains one of Asia's most important financial gateways and still operates under a common law system distinct from mainland China. If Euroclear-linked assets or banking relationships exist there, Russia could theoretically seek recognition through Hong Kong courts. But the legal hurdles would be significant. Hong Kong courts would likely examine whether the Russian proceedings met international standards of due process and judicial fairness. Euroclear would almost certainly argue that the closed hearings and geopolitical context undermine the legitimacy of the judgment. Public policy concerns could also become central. Hong Kong may not want to become the venue for enforcing one of the most politically explosive sanctions-related rulings in modern financial history. Still, Russia may view Hong Kong as more strategically approachable than European courts. The city is not institutionally tied to European Union sanctions structures in the same way Belgium is. Then there is Singapore, another major financial and arbitration center with enormous international banking exposure. Singaporean courts are globally respected for commercial independence and rigorous legal standards. Any Russian enforcement application there would likely face intense judicial scrutiny. Euroclear would probably argue that the ruling stems from sanctions retaliation, conflicts with financial stability principles, and raises concerns regarding procedural fairness. Singapore would also carefully consider the reputational implications. Because here is the thing: financial hubs survive on trust. Once investors start believing political legal warfare can spill unpredictably into major banking centers, confidence can erode surprisingly quickly. Taranov's analysis is that even unsuccessful enforcement attempts could still create pressure. Multiple legal proceedings across several jurisdictions could increase costs, complicate operations, and create uncertainty around Euroclear's international exposure. Beyond Hong Kong and Singapore, Russia could also explore jurisdictions in the Middle East, Asia, Africa, or Latin America, where Euroclear maintains operational links, correspondent accounts, investment holdings, or business relationships. Some neutral or non-Western jurisdictions may at least be willing to hear the claims. But even there, courts would still need to consider sanctions implications, financial stability concerns, and local public policy. Actually, this entire situation feels like global finance slowly entering unfamiliar territory. Not chaotic yet, but definitely less predictable than before. Physically seizing meaningful Euroclear assets would remain extremely difficult. Euroclear's core infrastructure and operational base are heavily concentrated in Europe, especially Belgium. European authorities remain deeply aligned with the sanctions regime that triggered the dispute. Belgian courts would almost certainly reject attempts that threaten European sanctions policy. In addition, much of Euroclear's infrastructure exists inside highly regulated financial systems protected by layers of legal and sovereign oversight. So even if Russia secures partial recognition somewhere abroad, identifying attachable assets that are both legally vulnerable and operationally accessible could prove extremely complicated. Yet the broader implications may matter more than the actual enforcement outcome. Countries across Asia, the Middle East, Africa, and Latin America are watching this dispute closely. The central issue is simple but profound. Are sovereign reserves truly safe abroad during geopolitical crises? That question alone could reshape reserve management strategies for years to come. Governments may gradually diversify away from Western-controlled systems, increase gold holdings, strengthen domestic reserve custody, or expand regional payment frameworks. Financial intermediaries may also become more cautious when dealing with geopolitically exposed sovereign clients. The risks now look far more visible than they did only a few years ago. And this is where Taranov's analysis becomes especially important again. What began as sanctions policy may now be evolving into long-term financial fragmentation. Russia sees the freezing of its reserves as an unprecedented assault on sovereign financial rights. Western governments view the sanctions as lawful responses to Russia's actions in Ukraine. Euroclear ended up directly in the middle because of its central role inside Europe's financial infrastructure. The Moscow ruling suggests Russia is prepared to use legal mechanisms as part of a broader retaliatory strategy against Western-linked financial institutions. Whether Russia ultimately succeeds in enforcing this judgment internationally remains uncertain. But even without successful enforcement, the case has already changed the global conversation surrounding sanctions, sovereign reserves, and the neutrality of international finance. And honestly, that may be the real story here. Not simply who wins in court, but whether the world's financial architecture is beginning to fracture into competing geopolitical blocs. This case could become one of the defining financial and legal confrontations of the post-2022 era. Its consequences may stretch far beyond Russia, Europe, or even Euroclear itself. Thank you for watching Taranov's Geopolitics. If you found this analysis valuable, stay with the channel for more deep dives into the geopolitical stories reshaping the global order. And remember, the financial world often changes quietly at first, until suddenly everybody notices.
If you like this video, please like, subscribe and share.